Good evening everyone, welcome to the official YouTube channel of Officers Adda 24/7. My name is Amanjyot and today we are going to discuss about the Basal Committee. Okay, so before starting the session, let me know, am I audible to all of you, and the PPT is also visible. Are we good to go? So today we are going to discuss about the Basal Committee, what is Basal Committee and what are the different norms was given by the Basal Committee. So we are going to discuss a brief introduction related to the Basal Committee and the Basal norms introduced by the Basal Committee. After that, we will practice certain questions in which we will implement all the concepts we are going to discuss today. Okay. So let's start the session. First of all, before starting this Basal Committee introduction, those candidates who are new to the channel, do subscribe the Officers Adda 24/7 channel and press the bell icon so that all the upcoming sessions notification will be given to you. Okay. So let's start with the Basal Committee. When we are talking about the Basal Committee, first of all, Basel is a name of a city which is in Switzerland. So there are 10 countries who participated in a certain summit which held in the Basel city, and they decided to make a certain international regulations related to banking sector. So international regulations related to banking sector was formed by the Basel Committee at the city which is known as Basel in Switzerland. So because of the name of the city, we have given the name to the norms we have introduced related to the international banking regulation, Basel norms. Okay. So first of all, the name of the city is Basel. So Basel is a city in Switzerland. Next, the Basel Committee on Banking Supervision, that is BCBS. The abbreviation of the committee is BCBS. So Basel Committee on Banking Supervision was formed in the year 1974 by the central bankers from the 10 countries. Okay. So first of all, Basel Committee is a committee which is formed to create or to formulate international banking regulation so that all the banking system in the worldwide will work similarly or will try to reduce the type of risk or the risk exposure which are happening in the banking sector. So the Basel Committee's main purpose was to create or to formulate international banking regulation. That's why there are 10 countries central bankers who went to the Basel city, attended the summit and decided to create a certain norms or certain rules and regulations related to the international banking regulation. Okay. So simply this was done in the year 1974. So the purpose of the committee is to ensure the financial institution have enough capital to absorb unexpected losses. So as we know, currently if we are talking about the banking system in our country, we are seeing that in India only there are certain banks who are facing a loss because of the NPA. Now what is NPA? NPA stands for non-performing assets. The asset of a bank which ceases to generate income for a bank, that is known as NPA. So NPA is a credit facility provided by bank to its customer on which the principal and interest is past due for a particular period of time, and this period will remain 90 days for all the loan sector, all the sector in which we are giving loan. It can be a housing loan, it can be an educational loan, it can be a term loan, it can be a credit card also. But for agriculture purpose, if we are taking loan, this duration will become 2 harvest season. For agriculture it becomes 2 harvest season, but when we are talking about the other types of loan, it is 90 days. Okay. So NPA, very good. It is stand for non-performing asset, the type of credit facility provided by bank to its customer on which the principal and interest is past due for a particular period of time. Achha, if we are talking about NPA, non-performing asset, what type of risk can arise in a bank in which because of NPA? So if we are talking about NPA, what type of risk will arise in a bank because of NPA? Is it a market risk? Is it a credit risk? Is it a default risk or operational risk or business risk? What type of risk is it? No, initially the countries were only 10 Manpreet. Okay. There were G10 countries who introduced the Basel Committee on Banking Supervision, which attended the summit in the Basel city, Switzerland. So when when a bank is facing issue related to NPA, now NPA creates a type of risk that is known as credit risk. So due to the NPA, we are facing the credit risk and default risk in the banking sector. Okay, credit risk and default risk. When the borrower of a bank is not able to repay or not repaying the loan to the bank, that is known as credit risk or default risk. So because of this NPA, credit risk is rising, default risk is rising in India. Same thing was happening in the year 1970s. So there are 10 countries who decided that we have to reduce this risk, we have to control the type of risk which are exposed to the bank, so that we will be able to perform all the banking transaction and we will be able to maintain the financial stability, the economic stability in the country. So that's why they have arranged a meeting in the Basel city, and the result of this meeting was the Basel norms, which was created by the Basel Committee on Banking Supervision. Now what these norms are simply international banking regulations which has to be followed by all the countries who are the member of the Basel Committee. Okay, now let's move forward. What is Basel Committee? First of all, Basel Committee has given us the certain Basel norms, and Basel norms are international banking regulations which was issued by the Basel Committee on Banking Supervision, that is BCBS. Now the Basel norms is an effort to coordinate banking regulation across the globe with the goal of strengthening the international banking system. So not only India but also all the countries are facing the different type of risk because of their functions, because of their supervisions, because of their regulations. Why we are facing certain frauds in the banking sector? Why we are facing certain defaults in the banking sector? Because in some cases there was a operational risk, there was a business risk, there was a legal risk. When the bank's employees are not following the norms or not following the restrictions which is given to provide the loan, then we are facing a certain fraud and default in the country. Not only this, there are other many reasons also, but there is also a one reason in which there is a default from the staff of a bank. So we have said that we have to make sure that the banking regulation or banking supervision will be done at the highest level, so that the bank are not facing the loss or banks will not face the risk related to banking sector. So that's why we have created the Basel norms in effort to coordinate the banking regulation at the globe, across the globe, so that all the banks will be able to perform their transaction and there will be no financial or economic instability. Clear? Now the Basel Committee on Banking Supervision were formed in the 1974 and the 10 countries were there who formed the Basel Committee. Now next thing, the BS consisting of representing from central banks and regulatory authorities of 27 countries including India. So India is also a member of Basel Committee. That's why we are following the rules of Basel. Okay. Now the Secretariat of Basel Committee is located in Basel city, which is in Switzerland, and which is known as BIS, Bank for International Settlement. So BIS is a secretariat, or BIS is in the Basel city of Switzerland, which is the secretariat of your Basel Committee, and BIS try to implement, or BIS gives certain regulations or indications or ideas to the central bank of different countries to how to implement the Basel norms and how they can maintain the financial stability and economic stability in their country. Okay, so BIS stands for Bank for International Settlement. BIS is oldest international financial institution which was established in the year 1930. World Bank, ADB, IMF, NDB, all the other financial institutions was introduced after BIS. So BIS is the oldest international financial institution which helps the central bank of different nations in their monetary and financial issues. Okay, so the BIS act as a bank for the central bank of different nations. Okay, do remember this line, that BIS acts as a bank for the central bank of different nations and its headquarters is in Basel, Switzerland. Now next is, when we are talking about BIS, BIS has a very important role in Basel norms. So first of all, it was established on 17th of May 1930. So it established in 1930, that's why it is the international, it is the oldest international financial institution. Okay, now its headquarters is in Basel and it has two representative offices, one in Hong Kong and second is Mexico City. Now the other thing is, Basel was established in 1930 and now right now 63 central banks are the member of BIS. So the BIS has a 63 central banks as a member, and for these 63 central banks, BIS act as a bank for them. Okay, so Basel Committee has issued 3 sets of regulation as of 2018 known as Basel 1, Basel 2 and Basel 3. Now do remember what is Basel Committee, what is BIS, what is the different functions of Basel Committee and of Banking Supervision and the Bank for International Settlement. Both are different, but both are working in the same direction to create a certain regulations which will be implemented in the international banking, so that the types of risk which are exposed to the bank will be reduced by these norms. Okay. So let's understand first of all what is Basel 1. So Basel was one was introduced in the year 1988 and it was implemented in the year 1998. So it focused primarily on the credit risk faced by the banks. Credit risk is the type of risk in which borrower is not able to repay the loan, or we can say borrower has did the default and not repaying the loan of a bank. That is known as your credit risk. Now, as per Basel 1, all banks were required to maintain a capital adequacy ratio of 8%. Now, let's first understand what is capital adequacy ratio, CAR or CRAR. It is also known as capital to risk weighted asset ratio, CRAR. Okay. Now, capital adequacy ratio or capital to risk weighted asset ratio is a capital which a bank has to maintain as a percentage of their risk weighted assets, so that in the future whatever risk will come, they will be able to overcome over this risk. Okay. So how to calculate the capital adequacy ratio? Capital adequacy ratio's formula is total capital will be divided by the risk weighted asset, that is RWA. It is written here, risk weighted asset into 100. Okay, so this is the formula of calculating the capital adequacy ratio, and all the banks in the year 1988 or in India when it is implemented Basel 1 in the year 1998, we have to maintain the capital adequacy ratio of 8%. Okay, that was the Basel 1 concept, and in Basel 1 simply we have introduced that we have to maintain a capital adequacy ratio that is 8%. This is the only norm or this is the only regulation given under the Basel 1. Okay, and it was followed by the banks. So banks has to maintain the 8% of capital adequacy ratio, and capital adequacy ratio is calculated by total capital divided by risk weighted asset into 100. Now this risk weighted asset covers the three type of risk, which is credit risk, second is market risk, and third is operational risk. Operational risk. These three types of risk will be covered under the risk weighted assets. Okay. Now this was the Basel 1. After that we went to the Basel 2, and Basel 2 was issued in the year 2004. First of all, Basel 2 was introduced in the year 1999, and it was said that all the countries have to implement it by the year 2024, but in India we have implemented from the year 2006. 2009. In India we have implemented from the year 2009. Now the Basel 2 divides the capital into three tiers. Tier 3 capital includes the short-term subordinate debts. For example, we have discussed that capital adequacy ratio is equals to the total capital divided by risk weighted asset into 100. This was the formula we have discussed. Now this total capital in the Basel 1 was divided into two types, that was tier 1 plus tier 2. Tier 1 plus tier 2, and the Basel 2 included the tier 1 plus 2 plus 3. So tier 1 capital was the capital which can be used by the bank to fulfill its losses, or this is the most or highest liquid asset in the Basel 1 tier 1, which will be used whenever banks face the issue or whenever bank face the problem. So the statutory liquidity ratio will be covered under the tier 1, and all the preferential share will be covered under the tier 1, because whenever you required immediate cash, whenever you required immediate help, you can use the tier 1 capital. Now tier 2 capital is not as much liquid as what the tier 1 capital, but it includes the subordinate debt. Now subordinate debt simply means the second liability of a bank, or we can say, for example, bank has issued two bonds on the two maturities. So the bond which was issued for the delay, or we can say the bond which has a later maturity period, that bond will be known as your subordinate bond. For example, we have two bonds, bond A and bond B. For example, when we are talking about debt instrument means you are taking a loan by issuing the debt instrument. So bond A has a maturity of 28th of May and bond B has a maturity of 28th of June. Now this bond B's payment will be done on the 28th of June and bonds A payment will be done on the 28th of May. But when we are talking about any financial institution, what they have to do, first they have to fulfill, or first they have to pay the liability of the bond A, then they can switch to the bond B. They can't go to the bond B before giving the payment of a bond A. Now this bond B will be known as subordinate debts, because this is the second liability of a bank, in which they have to pay the principal as well as the interest to the investor. Okay, so this will be known as your subordinate debt. And in tier 3 capital, we have included the subordinate debt, but the short term subordinate debt will be included in the year. Okay, so capital adequacy ratio covers initially two types of capital, tier 1, tier 2, then it includes tier 3 capital also in the Basel 2. Now the subordinate loans means lower in ranking. Okay, it is repaid after the other debts in case of bank liquidation. So first you have to pay the bonds or the liability which have a higher ranking, then you have to pay the lower ranking debts, that is known as subordinate loans or subordinate debts. Okay, so this is Basel 2. In Basel 2, we have to continue with the capital adequacy ratio, which was introduced in the Basel 1. Okay. Apart from that, we have introduced 3 pillars in the Basel 2, and these are the 3 pillars. Pillar 1 is minimum capital requirement, pillar 2 is regulatory supervision, pillar 3 is market discipline. So when we are talking about the pillar 1, that is minimum capital requirement, it simply says that all the banks have to maintain a certain percentage of their risk weighted asset with themselves, and that percentage, what 8%, it is the capital adequacy ratio. So the minimum capital requirement shows that banks have to maintain a capital adequacy ratio of 8% of their risk weighted asset. Okay, it will be continue in the Basel 2 also. Second is supervisory review process, or it is also known as regulatory supervision, in which it has said to the bank that they have required to develop and use better risk management techniques in monitoring and managing all 3 types of risk, which is credit, market and operational risk. Acha, if we are talking about the Basel 1, Basel 1 was only including the credit risk. Do remember this. Basel 1 included only the credit risk, but when we went to the Basel 2, we have seen that market risk and operational risk is also included in the Basel 2. So it includes the market risk, credit risk and operational risk. Okay. So the Basel 2 is saying under the regulatory supervision, it is also known as supervisory review process. So in supervisory review process or regulatory supervision, it has said to the banks that you have to develop more better techniques or more better risk management techniques by which you can monitor and manage all types of risk which can arise to a bank. And what type of risk can be arise? It can be credit, market or operational. Now credit risk is simply when the borrower defaults. Market risk is when bank has invested its market in the investment sector, or bank has invested its money in certain sector and that sector went to the loss, then this loss will be known as market risk. And operational risk is simply when the management of banks defaults or the technology which is using by the bank defaults, then it is known as operational risk. Okay. And the third pillar was market discipline. It increased disclosure requirement. Banks need to mandatorily disclose their capital adequacy ratio, risk exposure, etc. to the central bank. So it is simply that we have to maintain a certain discipline in the market. It means we have to follow all the norms, all the regulations, all the restrictions which was given by the Basel Committee or the central bank or Indian Banks Association or any other authority which is involved in the banking sector. So we have to make sure that we are disclosing each and everything to the central bank related to that how many capital adequacy ratio we are maintaining. Are we maintaining the capital adequacy ratio which is required or not? Then what kind of risk can be exposed to a bank? Which different type of risk can be exposed to a bank? And what was the level of the risk which can be arised by the customer? It can be disclosed to the central bank so that the central bank will plan accordingly to the risk. Okay, so these are the 3 pillars which was introduced under the Basel 2: minimum capital requirement, supervisory review process and market discipline. So this was the Basel 2. Now let's move to the Basel 3, and Basel 3 was introduced in the year 2010 and applied in India from 2013, but not fully implemented yet. Now the Basel III first of all said that in India it has to be implemented by the year 2019, March 2019. Then it extended, but RBI extended the duration of implementation by 1 year, and then it said we will implement in March 2020. After that, again because of the pandemic, we have increased the implementation date of Basel III. Now it is 2023. So from 2023, Basel III will be fully implemented in India. This is the new target of the Basel III. Okay. Now, first of all, we applied Basel III in India. We started to using certain norms of the Basel III in India from the year 2013. Now, in 2010, Basel III guidelines were released. These guidelines was introduced in response to the financial crisis of 2008. Why we have introduced certain new rules or new, we can say, guidelines after having the Basel II, because of the crisis of the 2008, we have seen that we need more reserves, we need more risk management techniques. There are multiple types of risk which can be exposed to the bank. That's why we have introduced the Basel III. Okay. Now in Basel III, certain capitals will be decided. First of all, first thing was decided that the total capital which a bank has to maintain, it should be your 9%. Okay. And it has said second that the tier 1 capital should be of 7%. Third, it has said that the capital conservation buffer, that is CCB, should be maintained 2.5%. Acha, percentage of, in Basel, whenever you are studying about the maintenance of reserves, don't always remember, in Basel norms we maintain the reserves as a percentage of risk weightage asset. Okay. And in monetary policy, this is in the Basel. Okay. In Basel you always maintain reserves in percentage of risk weightage asset. But in monetary policy, we have to maintain reserves as a percentage of NDTL, that is net demand and time liability. And in PSL, priority sector lending, we have to give loan as a percentage of ANBC or CEOBE, whichever is higher. Okay. So this is the condition which you should remember. Don't confuse with the NDTL, RW and ANBC or CEOBE. All the terms are different, all the calculations are different. So do remember, when we are talking about Basel, we have to maintain reserve as a percentage of risk weightage asset about all the reserves. So we have seen in the Basel III, it has said that the first total capital should be 9%, tier 1 capital should be 7%, capital conservation buffer should be 2.5%. And after that, we have said that the capital adequacy ratio will be now 11.5%. That should be minimum a bank has to maintain. How it should be 11.5 by total capital plus capital conservation buffer. So it created the 11.5 capital adequacy ratio, which is the minimum requirement which every bank has to maintain. Okay. Apart from that, as much bank can maintain capital adequacy ratio, the risk will be lower. Okay. High capital adequacy reserves, the risk will be lower. Now, why we are saying HDFC Bank, ICICI Bank, State Bank of India, these are the certain domestic systematically important banks, because from these banks we are maintaining additional reserves. Okay, so that because these are the banks which are involved or which are participating at the high level in Indian financial market. That's why these are very important banks for us, and that's why we have introduced as a domestic systematically important bank, in which they have to maintain reserves more than the other banks. Okay. So this is the Basel III, in which these are the requirements which have to fulfill. Now those candidates who are live in the session, do let me know, clear till now, whatever we have discussed till now about the Basel Committee or Basel norms, is it clear to all of you? And also those candidates who are live in the session, do like the session and share with your colleagues who are also going to prepare for this exam. Now this is the Basel III recommendation, in which said that the minimum common equity tier 1 should be 5.5%. Capital conservation buffer should be 2.5%. Minimum common equity tier 1 capital ratio plus capital conservation buffer, it should be 8%, that is 5.5 plus 2.5. Then additional tier 1 capital should be 1.5. Minimum tier 1 capital should be 7, that is 5.5 plus 1.5, that is additional tier 1 capital. Then we have to maintain tier 2 capital as 2%. The total capital will be 9%. 9% will be 2 plus 7%. and the minimum total capital ratio which has to be maintained, it is 11.5%, which is 9% plus 2.5% of capital conservation buffer. So these are the requirements, or these are the certain reserves which has set by the Basel Committee that you have to maintain. Okay, so this is the Basel 3. So we have discussed the Basel Committee, Basel Norm 1, Basel Norm 2, Basel Norm 3. First of all, Basel Committee was introduced in the year 1974. The name of the committee is Basel Committee on Banking Supervision. 10 countries has started it in the year 1974. Then the Basel Committee was introduced to ensure the financial institutions have enough capital to absorb the unexpected losses related to certain types of risk. Now, Basel Committee has introduced 3 types of norms, that is Basel 1, 2 and 3, and the secretariat of the Basel Committee is located in the Basel city, Switzerland, and the organization which helps us to implement the Basel Committee norms is BIS, that is Bank for International Settlement. It is the oldest international financial institution which was established in the year 1930. Okay, so these are the total information related to the Basel Committee and our Basel norms. So let's start practicing the question. The first question is on the screen, that which of the following is known as the third pillar of Basel II Accord. So you have to answer now that which of the following is the third pillar of the Basel II norms. Is it a minimum capital requirement? Is it a supervisory review process? Is it a standard approach, or is it a market discipline? The third pillar of Basel II. A, B, C or D. Which of the following is correct? Now answer quickly. Which of the following is true? Is it a minimum capital requirement? Is it a supervisory review process? Is it a standard approach, or is it a market discipline? So Basel II simply introduced capital adequacy ratio. We were continuing capital adequacy ratio in the Basel II and implemented introduced 3 pillars of the Basel II that are known as the framework of Basel II also. So which of the following is the third pillar of Basel II? A, B, C or D? Okay, so we are getting the option number D answer, that is true, market discipline. So first pillar is minimum capital requirement under which a capital adequacy ratio will be maintained. The second pillar is your supervisory review process, in which the bank has to be introduced better risk management techniques and better options to observe or to reduce the risk to which is exposed to the bank. And the third pillar is market discipline, in which the banks has to disclose, maximum disclosure should be done to the central bank by the banks related to your risk exposure, related to your capital adequacy maintenance. Okay, so the right answer for the first question is D. Second is asking the minimum total capital ratio under the Basel III is percentage of RWA. So in the second question we are asking the total capital which should be maintained by a bank as a percentage of RWA is 2.5%, 3.5%, 9% or 10.5%. Which of the following is true? A, B, C or D? Now what will be the answer of this question? 2.5, 3.5, 9 or 10.5? Do make sure we are talking about the total capital maintained under the Basel III as a percentage of risk weighted asset. So the right option is your 9%. Okay, total capital which should be maintained under the Basel III is 9%, which include your 7% of tier 1 capital and 2% of tier 2 capital. Okay, 7 plus 2, this is tier 1 capital, this is tier 2 capital, and including both the capital we will get the total capital, that is 9%. Okay, so right answer will be C option, 9%. Next, with reference to Basel III, how much capital conservation buffer are required to maintain? Capital conservation buffer is CCB. So how much CCB has to be maintained under or according to the Basel 3? Is it 3.5%? Is it 2.5%? Is it 7.5%? Or is it 1.5%? So what amount of or what percentage of risk-weighted assets should be maintained under the Basel 3 as a capital conservation buffer? A, B, C or D? What will be the answer? So when we are talking about capital conservation buffer, it's a new concept which was introduced under the Basel 3, which should be maintained by the banks. And by including this capital conservation buffer, the bank's capital adequacy ratio should be minimum 11.5%. Okay, this is the target for capital adequacy ratio, which is minimum. Okay, and banks are maintaining more than 11.5%. NBFCs have to maintain 15%, public sector banks are maintaining 12%. Okay, so right answer here is 2.5% capital conservation buffer under the Basel 3 has to be maintained of 2.5% of risk weighted asset. 2.5% of risk weighted asset. Okay, next. What are the elements of tier 1 capital including additional tier 1 capital as per Basel 3? So what are the elements of tier 1 capital including additional tier 1 capital as per Basel 3? So first is saying paid up equity capital is statutory and disclosed reserve. Second is saying capital reserve is representing surplus arising out of sale proceed of sale assets. Third is saying perpetual non-cumulative preferential share and debt capital instrument which are eligible for including under the additional tier 1. So which of the following covers the tier 1 capital which has to be maintained under the Basel? So we have discussed that in the Basel Committee for Banking Supervision, we have discussed that bank have to maintain a certain reserves. Okay, all the banks have to maintain a certain reserves. So the capital adequacy ratio is the first introduction of the reserve which should be maintained by the banks. Under the capital adequacy ratio, we have discussed that total capital will be divided by your risk weighted asset into 100. And that total capital will be divided into two parts, that is tier 1 and tier 2. So here it is asking which of the following covers the tier 1 capital. So right answer will be your all of the above. The tier 1 capital is highest liquid capital which a bank use. A bank can use at the time of immediate issue. Okay. So paid up capital, equity capital will be there. Statutory disclosed reserve will be there. Capital reserves representing the surplus arising out of sale of proceeds of asset, and perpetual non-cumulative preferential share, debt capital instrument eligible for including under the additional tier 1, all will be the part of the tier 1 capital of bank. Okay. Now the next question is, Basel Committee on Banking Supervision is a committee of banking super authority that was established by. So the Basel Committee on Banking Supervision is a committee which is a banking super authority which has given us the international banking regulation which are followed worldwide or which are followed across the globe. So which of the following has established this Basel Committee on Banking Supervision? It was established by RBI, it was established by central bank governors of the group of 10 countries, it was established by United States of America, or it was established by European countries. So which of the following has started or established the Basel Committee on Banking Supervision? Now do remember the abbreviation also, it is BCBS, Basel Committee on Banking Supervision. Now what will be the answer of the fifth question? A, B, C or D? B. Okay. So right answer for this question is B. Central bank governors of the group of 10 countries is correct, because 10 countries central banker had started the Basel Committee on Banking Supervision in the year 1974. Okay, so right answer will be B. Now let me know out of 5 questions how much you have done correct. Out of 5 questions how much you have done correct. Now one information for all of the candidates who are preparing for JAIIB June exam. So JAIIB selection batch is starting from 20th of May, in which it is a type of a crash course in which we are going to cover the previous year questions as well as the conceptual understanding of the very important topics from where in the past year questions are definitely asked. Okay, so this is your selection batch, or we can say this is a crash course for your JAIIB June exam. To enroll in this particular batch, you have to visit the Adda 24/7 application and you have to go to the JAIIB CAIIB section, and from there you can find the selection batch that is related to JAIIB. And to enroll in this particular batch, you can use a code that is Y496. If you use this code on the particular batch, you will get 78% discount on the MRP of the product. Okay. After apart from this, there are certain other batches also available, which is video course for bilingual and English medium for JAIIB preparation. That is a video course for you. And to enroll in this particular batch, again you have to proceed the same procedure, and you can use a code that is Y496 to enroll in these batches. After that, we have a certain test pack for your JAIIB and CAIIB preparation. In CAIIB, you will get 1500 questions, and in JAIIB, you will get 50 plus tests. And to enroll in the test pack and to enroll in the test books, you have to use a code Y496S. Okay, this is the code to enroll in a particular test pack. Acha, again, there is a sale going on in Adda 24/7 for ebooks. If you use a code Y496S, then you will get 22% off on the ebooks only, and this offer is valid for today only. This offer is valid for today. So if you want to enroll in a particular batch or in Mahapack, you can go for a code that is Y496, and if you want to enroll in a ebooks or the test pack, then you can use a code Y496. In the batch, you will get 78% discount. In the test book, in the ebooks, you will get 22% discount, and in the test pack, you will get 17% discount. Okay, so this is the limited offer which is available on Adda 24/7 application. So 3 out of 5. Okay, good, that's a good score. But as we know that we have discussed everything which I have asked in the question, so it should be 5 out of 5. Okay. So now let's end the session. Thank you all for joining the session, and if you are new to the channel, do subscribe the channel and press the bell icon so that all the upcoming sessions notification will be given to you.